Welcome back. You're watching Business Morning on Channels Television. We're starting our conversation now, and we'll be looking at exchange rate volatility and its impact on the industrial sector. I have two operators in that sector here with me on the program to talk about this. Being joined on the program by the Chief Executive Officer, Coleman Wires and Cables Limited, Mr. George Onofowoko, and Sir Orimadegun Agboade. He's the Chief Executive Officer of FEMA Pharmaceutical Industry Limited. Good morning, gentlemen, and thank you so much for coming on the program.
Good morning, Harriet.
Good morning, Harriet. Thanks for inviting me.
So, Sir Orimadegun, I'm going to start with you on this one. Exchange rate volatility has become a major issue, for all players in the economy. But how severe is the impact on the industrial sector?
Yeah, it's a very, very severe situation. And first, let me look at, is it coming as a surprise? To me, it's not, because for a company like ours that is solely on one product, and if anything happens to that, that's oil. If anything happens to it, then the whole, there's a spanner in the whole, thrown into the whole process. So it is a problem. Even in addition to that, you remember in January, in November, there was a deliberate devaluation of about 7-8%. Added to that, they now said that they group manufacturers into product areas. So they call some social product, and they asked us to go to DAS. That's DAS, Dutch retail market, to source our foreign exchange. The problem, the real issue, is even that the classification is not correct. When they say this is a finished product, then they will not take care of the input that will generate that product. So the semi-finished product, in my case, pharmaceuticals, you have bottles, pharmaceutical bottles, you have caps, you have foil. All these things are counted as finished products. And these are the things we need to, even when we get the raw material. So it's a huge problem.
George, it's been an interesting time. I remember the last time we had this conversation a couple of months ago, you were so excited about the new things that were actually coming in for the industry. You felt it was finally time. The rain was pouring. But now with this exchange rate volatility, does it still seem like the rain is pouring?
No, there are two ways to look at it. In one sector, in one way, there is still rain pouring. I'll explain myself. In another way, yes, it is not. The fact of the matter is the exchange rate volatility issue is affecting businesses, is affecting all of us. What Sir Agboade said is very true. The uncertainties on the actual definition of what is finished goods, what is raw materials, and what is not on the outDAS is also not helping. Coupled with the fact that what we've seen recently is that a lot of outDAS issue, which affects mainly manufacturers, you're finding bids are being returned. Now, I recently was speaking to some bankers on this issue in Treasury, and you're having a lot of returned bids. Where a bid has been going through bidding system for 3, 4, 5, 6 sessions, and it's still failing. Not on documentation, not on processes, no. And you find out the failures mainly now, what we're hearing and in the grapevine is the funds are just not available. So you find a bank going into CBN with outDAS for manufacturers for $30 million and coming back with 12 million accepted, while the remaining 18 million most likely are just written orders because in reality they don't have the funds to back it. And I went into an argument with some of them that this doesn't make sense. If CBN is trying to protect manufacturers and some of the sectors with outDAS by saying, okay, you can buy outDAS rather than buy interbank, you then have a situation of where is the money going to? And I was shocked at the answer today. And the answer was the majority of the funds were going to the oil and gas sector for paying off petrol and diesel. So the priority of CBN, for some God knows reason, why we're all failing our bids to even buy even on the outdoors is petroleum and diesel. So now the government is looking for money to give to the petroleum to make sure petrol is available, but then we should not be able to gain our raw materials. Then you're also looking at the issue of this finished goods issue. You're having not only what they're talking about in pharmaceutical, even in the manufacturing sector overall, you're having an issue now of people doing their expansion and having trouble. Because machinery, for some reason, also has entered finished goods.
Yeah.
So if I want to even buy machinery to fix my factory or to even expand my factory, I have to go and buy it at today's rate. It's 199 on interbank. How do you survive? How does that project survive from 170 to 199?
199, what the central bank says is about 188.60 naira.
You see, this is unfortunately, we shouldn't call it manipulation. Now, if you try interbank in the morning, it is as high as you can think. In the afternoon, it is as high you can get. Now, in the evening, just before the close of trade, central bank all of a sudden brings intervention fund. And then the dollar, and you hear the close of day trade is 186. Now, all through the day, it was 190 something. And at 5 o'clock, 5 minutes to it, $250 million entered the system and the price dropped. How many of us got that pricing? You find out that almost 90% did not get any of that. It happened at the end of trade.
So there's still a shortage of
it is
information.
Yeah, so you're finding out the reality is a lot of dissemination of information is out there, but what is reality to the manufacturer is what we're talking about, that we're not being able to get this type of funds that we claim to be assigned to where it's even available. So let us even find a solution for that, because the impact analysis of that is the price will be passed on to the consumers at the end of the day.
So now looking at where we are and the central bank's efforts, are they enough? Because from what you've just said, it seems as if it comes in at that dime minute, and investors or operators do not get to hear about this intervention until maybe the next day. And so it almost seems as if, look, I've lost a lot of bids, I've lost a lot of business owing to the fact that I did not get information at the right time.
Then yes, to follow that what George said, when you queue up for the DAS and 1 week, 2 weeks, 3 weeks, you'll be frustrated. And you will now say, okay, why not go to the open market? So the implication of that is that you are buying over 25% more. And the implication of that again is that, can we pass this on to the customer? In some cases where products enjoy some monopoly, yes, you can pass a bit. But in pharmaceutical, which is seen as a security issue, because when you do, you can't take care of the people, then what is it we are talking about? So all these things may not be able to go to the end user. And don't forget, there are some of our brothers and sisters out there that they have challenges that require them to use a particular drug, for a long time. In fact, for the rest of their lives, to manage some health issues. If you now say, okay, put 20% at a go, put 30%, and if you look at the thing critically, it's even more than that. Don't forget, in December, the minimum wage was moved from 36 to 45. And of course, that's about 25%. So, see, all these increases, who will bear the result? So, and this, if it is a thing, for instance, the first devaluation of 158 to 169.
155 to 168.
Yes, 155 or, well, 155 to, that's about 7-8%. That, in my industry, we count it as a loss. Why? There's nobody to pass that one to. As you are battling with that, another one came in.
Well, George, you seem to be agreeing to that as well.
I'm agreeing to that, because at the end of the day, that first devaluation is a direct hit on any manufacturer, because you're sitting on stock. Most likely, in Nigeria today, most manufacturers have their working capital in dollar-based finance, which is import financing. And most import finance run on a 90 days or a 180-day cycle, depending on what type of agreement you have with your bank. Now, you have a scenario where you've already bought materials, it's already sitting with you, and you've got maybe even $1 million or $10 million of actual raw materials. And you then take a direct hit of maybe 10 naira or even 20 naira, depending on what area you are in. So if I have $10 million and that first impact happens, it's still sitting stock. I haven't paid the bank. The bank is very happy to borrow me money in dollars and is borrowing any other manufacturer. Now you have a $10 million issue, you take a 10 naira each, immediately it's 100 million each. You take a 20 naira each, it's a 20 million each. So 200 million each, direct on your raw materials that you're even sitting on before you even talk of buying new one. So how do you first recover even that 100 million or 200 million direct? It is a catch-22 scenario. You cannot win, you cannot lose. You're just in your own shell.
So what, are you saying that, because there's been this argument that this is the best time for manufacturing sector because the exchange rate, yes, is the way it is, but it's a good time for manufacturers to begin to export.
I agree, because if we are an export-dependent country, it's fantastic, or orientated country, then it is fine. We're still not. We're an import-dependent country. We have some element of export. We're still perfecting our export, non-oil export. I think we should focus on that. And non-oil, which is where the manufacturers are focused on. Now, the thing is, you impact the economy in the exchange rate, you need to try and balance it. I think they finally woke up to that. I think the last time I was here, I was also clamoring for it that, look, if you take a shock on the system, you need to actually find a way
to buffer it.
Now, finally, last week, they also announced on, I think, Wednesday or Thursday last week, they announced a 300 billion intervention fund on expansion, which ranged between 500 million to 10 billion. Now, at an interest rate of 9% from the central bank. Now, directly with the deposit financing bank or any DFD. So now the advantage of that is that you're trying to buffer the actual weight loss of what is going to happen. Now, I've spoken to kind of a bit of the financial services people. They're very interested in this. Now, the advantage of that is the last discussion I had with one of them, which was fantastic. I actually did not think about it that way. He said, look, the impact of this 300 billion is interest rate will go down. And I said, why? I said, look, we cannot take 300 billion from central bank, refinancing our position. That means we're back with 300 billion on our books. We need to give it back out again. So indirectly, the 300 billion intervention fund is actually, inverted commas, a 600 billion intervention fund, because 300 billion goes out of the banking system. 300 billion is now back in their hands. They can't keep it because they have to justify shareholders' funds. Now, what happens is it becomes more competitive because they need to give out this additional 300 billion. So interest rate will generally, I think, over the next few months, as this money comes into the system, interest rate will be forced down. Now, those are buffering elements, which the central bank, I think, finally has thought of. I think they should have thought of this in December as they were doing these shocks. But it's never too late because unfortunately, I think we are happy that the actual financial sector is actually happy to support this one. So that's the only good thing about it.
So with this support now, the cost implication with regards how because of how much you're spending running your businesses, will it still be bounced on the customers?
Well, it depends. If it works, I've heard about what my colleague George said.
They want it to work, which is the reason why the deposit money banks are really buying into it.
Harriet, it's good to ask what happened to the previous ones. 220 billion. By the grace of God, I belong to NASME, and I can say that none of my members had gotten. So it's good to bring them like this, but I think we should now ask ourselves, the previous one, the one before the last, how did they go? Let me also chip in this as one of the critical factor in the pharma sector. Most of us pharmaceutical manufacturers in Nigeria, we have either association with foreign companies. You take bills for collection. You take the goods today, you say you pay in 3 months' time. Now, we just woke up now that you need more naira to service what you have taken. So where do we go from there? So we still need to look at the definition of all the inputs that make a product and classify correctly. Then follow this up. Just don't put it on your website or with the banks. That is these fundings, this kind of funds. And then follow it. How is it working? Who is taking what? Let them tell the whole world how many people have taken. So these are good intentions, but we need to follow it through and see that they reach us, the people that need it.
Well, gentlemen, let's take a quick break and come back and continue this conversation. You're watching Business Morning on Channels Television. On the program today, we're looking at exchange rate volatility and its impact on the industrial sector. I've been having a conversation with 2 operators in this industry, the Chief Executive Officer, Coleman Wires and Cables Limited, Mr. George Onofowokon, and Sir Orimadegun Aguade. He's the Chief Executive Officer of FEMA Pharmaceutical Industry Limited. Both gentlemen will still be here with me in the studio when I return in a moment. Please join us again.